Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing F5 stock so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 9.6 billion market cap. They're trading at $159 a share and they have 60 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have positive free cash flow each year. It's highest in the trailing 12 months at 850 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's really consistent, around 300 million a year. Revenue is the sales for the company, and that goes up a little bit from 2.35 billion to 2.8 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 13 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $12 billion. We divide that by 60 million shares. And we get a calculated stock price of 196. They're trading at 159, so they're trading at a 19% discount. It's a buy according to the model. I think this is one of those companies that flies beneath the radar. They seem like a good value, but people just aren't aware of the stock, so they're not buying it. There are 143 companies in the same industry as F5, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 42 million in CapEx, the median is 16 million. They have a really low debt to equity ratio, only 0.1. Microsoft is 0.3. Look at Oracle, 84. They don't pay a dividend. Not many companies in this industry pay a dividend. They do generate more free cash flow than the average and median. They rank 29th in market cap. The average is 28 billion, the median is 1.8 billion. They have really good price multiples, better than the median and average in every category. They generate a little less revenue than the average, and their 5-year annual revenue growth rate is only 6%. The median is 12%, average 15%. F5 released their earnings this week. Their June 30th, 2023 earnings. Since their fiscal year ends September 30th, it's considered their third quarter. You can see right here, F5 reports third quarter fiscal year revenue growth. Their revenue for the quarter is 700 million, up from 674 million. Global services revenue grew 8%, but product revenue only grew 1%. Gross profit for the quarter, 561 million. That's an 80% margin. Software companies tend to have high margin. Even though their gross profit was lower last year, 544 million, they had higher margins, 80.6%. Operating profit of 104 million, operating margin 14.7%. When you compare that to 2022's number, 107 million, operating margin 15.9%. Net income of 89 million or $1.48 per share, compared to last year's number of 83 million or $1.37 per share. GAAP is generally accepted accounting principles. When you see non-GAAP, that means a company adjusts the numbers. They remove things like stock-based compensation, and they also remove non-recurring items, like large impairments. I usually look at GAAP numbers when I do my videos. Revenue of 700 million, up from 674 million. Gross profit, 561 million. Gross margin 80%, operating profit 104 million, operating margin 15%, net income 89 million, EPS of $1.48. Their numbers are pretty similar to last year. So when you take into account inflation, the company's not really doing that much better. Let's look at their income statement. Their product revenue is pretty much flat from last year, but their services revenue went up quite a bit. And that's where most of the margin is in services. Because even though they had less product revenue, the cost of revenue is more. In order to generate the 328 million of revenue, it cost them 88 million. For the services, the 374 million, the cost of revenue is 53 million. So you might ask, why don't they just do services and not products? Because most companies can't service anything unless they sell a product to a customer. So their gross profit is 561 million. For the trailing 12 months, it's 1.7 billion, up 50 million from last year. Their largest expense is sales and marketing, 207 million, R&D, 129 million, G&A, 65 million, And then you have restructuring charges, 56 million. They explain right here what restructuring charges were. This was mainly due to payroll, they call it workforce reductions, and also exiting facility leases. And restructuring is excluded from its non-GAAP financial numbers because that's not a recurring item, so they exclude it. Operating expenses of 457 million, up from 436 million. It's up because of the restructuring charges. That's why their income from operations is lower, 103 million compared to 107 million, because of the restructuring. Their net income is higher, 89 million, compared to last year of 83 million. Because this quarter they had positive 3 million in other. Last quarter they had negative 6 million in other. Their shares outstanding are pretty much flat, 60 million in both time periods. Let's look at their balance sheet. Current assets of 1.7 billion. Current liabilities of 1.5 billion. So their current ratio is above 1. They can cover their current liabilities with their current assets. Their cash is down from last year. It's 677 million. Last year, 758 million. They're owed 439 million in accounts receivables. This is when you sell on credit. Other of 537 million. Property and equipment, 170 million. 200 million of operating leases. The 200 million is the value of the asset they lease. If you look in the liabilities section, they owe 250 million on those leases. A right of use asset is carried in a balance sheet as if the company owns it. That's why it's an asset and liability. Deferred tax assets of 270 million. This will lower their net income in the future, which means they'll pay less taxes. Goodwill is their biggest asset, 2.3 billion. This is when they acquire another company for more than their worth. So total assets 5.1 billion, down from 5.3 billion last year. Deferred revenue is their largest liability, 1.1 billion. This is when a customer prepays for a product or service they're going to receive in the future. This means they received payment for something they're going to have to deliver in the future. So they receive the cash, so cash goes up and the liability deferred revenue goes up. When they deliver the product to the customer, then they reduce the liability and increase revenue on the income statement. In the long-term portion of the balance sheet, more deferred revenue, 640 million. So total liabilities, 970 million, up a little from last year. Let's look at the equity section. They raised 33 million from selling stock. They profited 2.6 billion from running their business. Retained earnings is a sum of all their prior net incomes. Let's look at their statement of cash flows. Operating cash flow is how much cash the company generated from an operational business, 460 million. Net income is not actual cash, it's your accounting profit or loss. That was 240 million. The reason they generated so much more cash flow than their accounting profit is because of stock-based compensation. That's a non-cash item that brings down your net income, but we add it back here. They spent 35 million of acquisitions. They spent 39 million in buying CapEx. They repurchased 290 million of common stock. Last year, they repurchased 500 million. These numbers are for the trailing 9 months. They don't have the quarterly statement of cash flows. They've done one stock split in 2007, 16 years ago, a 2-for-1. If you invested $10,000 into this company 10 years ago, you'd have $17,000 today. That's a 5.5% annual return, a 71% total return. Let's look at the company on Simply Wall Street. Its last price was 150, market cap 9.1 billion, up 1.5% in the past week, down 3% in the past year. Let's learn a little more about the company. F5 provides multi-cloud application security and delivery solutions in the US, Europe, the Middle East, Africa, and Asia Pacific. The company's multi-cloud application security and delivery solutions enable its customers to develop, deploy, operate, secure, and govern applications in any architecture, from on-premises to the public cloud. It offers application security and delivery products, including big IP appliances and Viprion chassis, as well as related software modules and software-only virtual editions, Application Security Manager, and Access Policy Manager. They provide a range of professional services including consulting, training, installation, maintenance, and other technical support services. It sells products to large enterprise businesses, public sector institutions, governments, and service providers through distributors, value-added resellers, service providers, systems integrators, and other indirect channel partners. It has partnerships with public cloud providers such as Amazon Web Services, Microsoft Azure, and Google Cloud. Those are the three largest cloud-based platforms. The company was formerly known as F5 Networks and changed its name to F5 in November 2021. They've been around since 1996, 27 years, and they're headquartered in Seattle, Washington. The risk they list is significant insider selling over the last 3 months. It looks like they started trading in 1999. Just after a few months, the stock got up to almost $80. And I think they really suffered during the dot-com crash. It bottomed out to $229. Then from 2001 to 2007, it had a steady growth. It dropped in 2008, possibly from the Great Recession. But ever since 2008, the stock has done really well. It peaked at $243 at the end of 2021. It did fall to $134 in April 2023, but it is creeping back up. So it's still trading at a pretty big discount relative to its all-time high. Simply Wall Street's valuation is $315. They say the stock is 52% undervalued. 13 analysts priced this stock and the average price target is $157. They say it's 4.5% undervalued. In 2012, their trailing 12-month revenue was $1.4 billion. And it pretty much goes up every single year. Not a ton, but it does go up little by little. It's up to $2.8 billion in March 2023. Their revenue forecast for 2025 is $3 billion. They rarely use debt. They're currently debt-free. They did have a little debt last year, and their equity is higher than ever at $2.7 billion. The CEO's salary is $925,000. Total compensation, $12.8 million. Their tenure as CEO is 6.3 years. In the past 3 months, there's been only insider selling, no buying. That's not something you like to see. 88% of the company is held by institutions, 9% by hedge funds, and 2% by the general public. Their biggest shareholder is Vanguard at 12%, 7 million shares valued at $1.1 billion. Their employee count more than doubled since 2012. It was 3,000. Now it's 6,700. The ticker trades on the Nasdaq, Deutsche Börse, Xetra, Mexican Bolsa, London Stock Exchange, and Sao Paulo Bolsa. So that's the end of the video. Let me know what you think. Thanks for watching.